Good evening. My name is Susan Moon, and I'm the Executive Director for the Walnut Creek Library Foundation. Thank you for joining us for our second program in our Finance 101 series, Why Should I Own Life Insurance? The Walnut Creek Library Foundation raises funds to provide free programs, purchase equipment and supplies, and add to the collections of our two Walnut Creek libraries. I'd like to thank our Finance 101 series sponsors, Kathy and Jerry Hicks, for making these programs possible. This evening, we follow with a discussion on life insurance. Life has its surprises, and we all need to be financially prepared for unexpected calamities. Our presenters will share with you how life insurance is important for business people, individuals, and especially families with children. In 2 weeks, on April 8, we will discuss Medicare planning and special needs trusts. And we wrap up the series with a deep dive into Social Security and Medicare on April 22nd. Our programs are and will be recorded and can be found on our website or YouTube channel if you miss one. We are delighted to have professional advisors located here in Walnut Creek to offer their time and expertise in these subjects. Tonight, we are pleased to introduce JP McDermott and Jane Vidal of MML Inc. JP has been in the insurance and financial service business for over 25 years. He graduated from UC San Diego, majoring in economics and communications, and secured an MBA from St. Mary's College. For the past 20 plus years, he's taught finance in high school as part of the Junior Achievement NorCal ongoing financial literacy program. He also serves on the board and executive committee of Junior Achievement NorCal. Jane Vidal has 15 years of experience in the financial services industry. She graduated from Cal State East Bay School of Business with a degree in business administration and a concentration in finance. Jane volunteers and helps low-income taxpayers file their income tax returns through the IRS's Volunteer Income Tax Assistance Program. With her busy work and volunteer schedule, we're happy she could join JP for tonight's program. Following their presentation, we will have a brief Q&A, and you can submit your questions in the Q&A box below at any time. Please join me in welcoming JP and Jane.
Thanks,
Hello.
Susan. Jane?
Take it away.
Good evening. Thank you, Susan.
Thanks, Susan, and welcome. I want to thank you all for taking some time to learn about life insurance. It's kind of one of my favorite topics because it's not the kind of thing that most people really like to wake up in the morning and say, I think I need some life insurance. So what we hope to do tonight is to educate you on some of the ways that, as Susan mentioned, businesses, individuals, and most importantly, families can use it to protect their assets, and mainly to protect their loved ones. So I'm going to go ahead and share my screen now. Okay. So our lawyers make sure that we let you know that we're not giving legal advice or tax advice, but really just educating you on this important topic. You can come back if you're really interested in reading all this at the end or at the recorded session, but let's go ahead and move into the heart of the program. And what we do with our clients, Jane and I are financial planners, and we work with individuals and businesses and help them actually develop a roadmap to and through retirement. And a key component of any financial plan is the protection portion. And in this case tonight, we'll be talking about life insurance. But when we start off with clients and kind of educating them about financial well-being, we like to just define what that means. And very simply, it means having control over the day-to-day, month-to-month finances that we all face, having the capability or the capacity to absorb a financial shock, being on track to meet financial goals, and having the financial freedom to really allow you to make the kinds of decisions to enjoy life and sleep better at night. When we talk about life insurance protection products, we're really talking about the second bullet here, and that's having the capacity to absorb a financial shock. And certainly a premature death can be not only emotionally shocking to the family, but also financially devastating. So what we're going to discuss tonight is these four areas. What is life insurance? How does it work? What are the types of life insurance there are out there? What else can permanent life insurance do? We'll talk a little bit more about that because that seems to be a little bit of a well-kept secret. And then finally, how much do you need? We get that question all the time. What's the right amount of life insurance? And what do you think the answer is? Well, it depends, right? Everybody's situation is different. And somebody that's running a large business is going to have different needs than maybe a single person, but has others that are depending on he or she for their financial support. It could be a relative, it could be an aging parent. So everybody's situation is different, and we'll cover that as we move through the program here tonight. So let's talk about what it is. The definition is that it's a financial product that provides a death benefit, doesn't that sound lovely, to identified beneficiaries upon the death of the insured. So that's a pretty clinical definition, but in reality, it's really providing a level of protection for your loved ones. An insurance death benefit can be used for in a number of ways. It's primarily for income replacement. It's for eliminating debt. Specifically, a lot of people get life insurance in the event of a premature death with enough death benefit to cover their mortgage balance or other kinds of debts. And then also paying for future expenses. People get life insurance in the event of a premature death to make sure that there's money to provide an education for their children down the road. So there's lots of different ways and lots of different reasons that a death benefit can be used in a life insurance policy. So who should consider getting life insurance? Well, anybody who has loved ones that depend upon them financially, and those who anticipate a change in their family status and really want to make sure that they have the protection while they're still young and healthy. I'm going to come back to that. But anyone who has loved ones that depend upon them financially, I mentioned it's extremely important and popular for families, especially with children, that the parents and breadwinners have some level of life insurance. But it doesn't mean that if you don't have children or are not married that you don't need it either. And again, I come back to think about anybody who might be dependent upon you either now or in the near future for financial support. And that could be, again, a relative, it could be a parent that might have a need for something if you're no longer there. And I mentioned I wanted to come back to young and healthy. People ask, when's the best time to get life insurance? And it's funny because life insurance is priced based on your age and your health. If you think about it, the younger you are, the much further away from your expiration date you are. So it's going to be less expensive. Unfortunately, most of the people who realize they have a need for life insurance are now in their 40s, 50s, and even 60s when the cost of that life insurance, just because they're closer to their expiration date, is much higher. And also, as we get older, our health is generally not as good as it is when we're very young. So what's the takeaway here? It's always best to get life insurance when you're young and healthy because it is, as I'll say, cheap. It's as least expensive as it will ever be for the rest of your life. So that's kind of what I'm talking about. The dilemma is when we're young and we have the ability to get life insurance because of our health, and that also we're very young and it'd be inexpensive. But generally when we're young, we don't have the resources, the financial resources to get large policies. But by the time we do have those resources, again, now we're older and maybe not as healthy. So when we're counseling young people, especially in their first jobs, we encourage them to think about locking in a policy, because once you've locked in the price, we'll talk about this in a few minutes, once you've locked in that premium in a policy, no matter how old you get or what your age is or what your health is, you've actually locked in that low premium, and there's some real benefit for that down the road. So let's talk about the types of life insurance that there are. We have term insurance and we have permanent insurance. Term insurance is probably the most popular. Often companies provide it to their employees. It's called group life insurance. And it is essentially a term insurance policy, but instead of a term being 10, 15, 20, or 30 years, the group life insurance is based, the term is based on the time you're employed by that company. Oftentimes, when you leave the employment of the company that you're with, your life insurance goes away. So we often, and also it's limited. Generally, companies that do provide group life insurance, it's usually 1 or 2 times their base salary is the amount of coverage that they provide. Often they'll provide the employee the ability to purchase supplemental insurance, and sometimes that makes a lot of sense. However, it's also important to perhaps get more insurance on your own outside of your employer in the event that you leave that employer, or voluntarily or involuntarily, you have a policy that's portable and will stay with you for that term. So term insurance, think about it like renting a home. You are renting the home for the term of the lease. In this case, the lease is 10, 15, up to 30 years, depending on your age. And that premium that you get for that policy over that term is locked in. So the monthly payment will stay the same over that 10, 20, or 30-year period. The longer that you get that term insurance for, so let's say 30 years versus 10 years, the 30-year policy is going to be more expensive because the insurance company recognizes that they have to insure you through those next 30 years. And it's more costly for them because you're getting older than it would be for somebody who's only going to get it for 10 years. So at the end of the question's always, well, what happens when at the end of the term? You think about it like at the end of your lease in your apartment or your home that you're renting, and the landlord can double or triple their rent. That's what's going to happen. You're out, and to continue staying there, you'd have to pay the new rental price. With life insurance policies, at the end of the term, while it doesn't technically go away, now the cost is such that it might have gone up exponentially, and very, very few people can afford to continue that existing term policy. And again, think about it. If you're in your 30s when you get a 30-year term policy and it expires when you're 60, now to get new coverage at that point, it will be very much more expensive just because of your age, and we don't know what your health will be at that time. Permanent life insurance. Actually, I'm going to go to the next slide. Let's talk a little bit more about term. This is really just stating in writing what I just said. It's for that period of time. The takeaway is the premium stays the same over that period of time, and you have coverage over that period of time. And one other thing too, life insurance companies like to sell term insurance policies because they know that less than 2% of the policies that are in force will they really have to pay on, because 98% of the people who pass away, their term policies have already expired. So for them, they like the fact that it's a good odds for them and a good return for them to provide that. It's still a great benefit because none of us knows, we don't have our expiration dates on our wrists that tell us how long we're going to be around. So we never know that. And it is a very important component to have. The alternative is what's called permanent life insurance, and that comes in a couple different flavors. Permanent life insurance offers this lifetime protection as long as the policy is in force. And unlike term insurance, every permanent life policy, especially whole life policies that are written, the insurance company knows they will have to pay that death benefit at some point when the insured passes away, as long as that policy remains in force. So, and using the same analogy of leasing your home or your lodging versus leasing and renting your life insurance, think of permanent insurance as now you're owning it. Just like you own a home, every premium payment you make, like every mortgage payment you make, some portion of that is actually going into equity into your home and actually equity into the policy. So these types of permanent policies, there's whole life insurance, and then there's universal life insurance and different types of universal life insurance, which I won't be going into a lot this evening, except to say that these policies actually have what are called living benefits. They have cash that accumulates inside of these policies that are available for you while you're alive. You don't have to die to be able to tap it. So let's look at some different comparisons here of term versus permanent insurance. Term, by definition, is pure insurance. It is therefore lower cost. And when I say pure insurance, think of it more like what you pay for your car insurance or your home insurance. At the end of the period, or when you sell your car or you sell your home, there isn't any value there. So same with term life insurance. There's no value that accumulates in it. It's simply you pay the premium to mitigate the risk of a premature death. Permanent insurance is not low cost, just like owning a home, it has more expenses, but then unlike the term insurance, over time, the premiums you've paid into that policy over time, you'll actually be able to get back all the money that you put into it and more over time. Both of them offer a death benefit that is currently free of any income tax in most cases. There are some very few exceptions where there might be businesses that will take out insurance policies, but for most of us, that death benefit is income tax free. Lifetime protection, well, we just explained that term insurance is for a set number of years, and after that, it becomes prohibitively expensive. So you don't have that term insurance for life, but permanent insurance, you can have it for life. And then from a potential cash value accumulation, there's none in term insurance. And permanent insurance, it says maybe, but if you keep the policy in force, it actually can become a very nice asset over time. So like investments, real estate, and retirement accounts, permanent life insurance can actually be an important financial asset, as I mentioned. In fact, if we think about investments just for a moment, and you think about if you have a 401k or you have an IRA or you just have an investment account and you get your statements, oftentimes there will be a pie chart that will show you what percent is in equities or stocks, what percent is in fixed income or bonds, what percent is in cash. And what we like to say is permanent life insurance policy in that mix of assets that an individual owns can provide that fixed income portion of their investments. And it actually can give them, we call it a permission slip, to be a little bit more aggressive, buy more in the equities and stocks, because you have this guaranteed cash value that's fixed income, and it's not tied to the stock market. So even the bond portion in investments has some volatility, but the whole life insurance policy inside of your investment mix has guarantees, and we'll talk about that in a moment. It can be a very powerful financial asset. In fact, somebody once called whole life insurance the Swiss Army knife of financial instruments. So let's talk about the cash value that accumulates. The cash can be used for any purpose. So unlike the money in a retirement account, a 401k, for example, while you can borrow it, it does have some very strict limitations about how much, repayment options, it has to be paid back. Taking money from IRAs, there are strict rules about what you can take the money and use it for without penalty. So sometimes for medical expenses, for higher education, or for first-time home buyers, but still very limited and lots of rules around it. The cash inside your whole life insurance policy is like cash in a savings account. It's, if you need it, there aren't any forms to fill out. There's no requirements that the insurance company has. It's your money. It can be used for anything. Frequently, it's most used for things like retirement income to supplement Social Security in retirement, to help pay for college, and it's also a source of cash or credit. So what some have used the cash in these policies for is, again, like I said, it can help add to any type of retirement income. Lots of ways to do that. You can, this one is really important. And for a lot of clients, they like this idea. And I'm going to go off the script just a moment. But what the second bullet here, managing a rate of withdrawals from retirement accounts during down markets, that's a mouthful. We like to call this concept or strategy a volatility buffer. So imagine, if you will, you have a big bucket of money when you retire that you now have to make sure lasts for the rest of your life. And a lot of that, if not all of it, might still be in the stock market. So to safely be able to have a 30-year retirement, there's you can Google this. There's a concept called the 4% rule, which used to be fairly accurate, but in the last 10 years with a zero interest rate environment that we've been experiencing, that 4% has actually dropped to more like 2.67%, which simply means that you can take only that 2 to 4% of that pool of money you have each year and have a 95% chance of not running out of money. The problem is that we have in the stock market, the stock market only does two things, right? It goes up and it goes down. It goes up more than it goes down. However, if you have to pull money out of an account that suddenly dropped 20%, you're now pulling money from an asset that's declining and taking even more out of it. So wouldn't it be nice to be able to pause and not take money out that year that we're in a bear market, but instead have another pool of money that you can pull for living expenses? And that could be the cash inside that life insurance policy, right? And so the last bullet here is simply creating an additional source of retirement income. That's what people do. They like to see something that can last them for any number of years or possibly even for life. There's ways that the cash value inside life insurance policies can actually be exchanged into annuities that will provide lifetime income. So it does have an awful lot of flexibility. The death benefit can be used for future college expenses for children or relatives that you want to provide for. And also policies, cash value can be used while you're alive to pay the costs of college related expenses. In fact, a very popular thing that many of our older clients have been doing is purchasing whole life policies for new grandchildren. And the cash that builds up by the time they're ready to go to college can greatly help supplement the cost of their education. And by the way, these types of policies, many of the whole life policies, have limited periods of years that you can pay, after which they'll be paid in full for life. So these policies that are purchased for children, not only can they use that cash for college or a down payment on their first home or a wedding, but they'll have that policy for the rest of their lives. So we call it a gift of a lifetime. They're wonderful, wonderful ways to provide a gift that keeps on giving. So it can be a source of cash or credit. Certainly emergency funds. We always start with our financial planning clients to make sure that there's a 3 to 6 month reserve of income for those unexpected expenses and emergencies. And often I like to say that we tend to focus on the negative when it comes to emergency reserves. But once or twice in a lifetime, sometimes opportunities come along that if you have that reserve, you can take advantage of them. Cost of healthcare services. Healthcare as we get older gets very expensive. Business funding. And family life events. Let me tell you a story. I think you all know who Walt Disney is, and he was a very successful cartoonist and movie maker. And when he went to his bankers to get financing for this dream he had, this idea, they kind of laughed at him and said, "There's no way we're going to provide money for that." So he walked out of there and took money out of his whole life policy to start Disneyland. That's a true story. So people use that money for all kinds of things. There's no limits. It can start a business. It can help with weddings. It can help with certainly final expenses. There's whatever you can imagine that money can be used for. So consider your value to your loved ones from the terms of what your annual income is today, what your employer provided benefits are offering if you have those, and then think about the unpaid services that you provide. So we have annual income, child care, transportation, maintenance, elder care. These are all things that life insurance can help with. As far as how much do you need, I'm going to give you a website. It's a nonprofit. It's not affiliated with any insurance company, but it's called lifehappens.org. And it has some terrific calculators to be able to calculate what's the right amount. There's a number of ways that life insurance needs can be calculated. And very simply, just rule of thumb, especially for young families with children, is generally anywhere from 10 to 20 times their annual income. So somebody making $100,000 a year should have anywhere from $1 to $2 million of life insurance coverage. Now, $2 million of permanent life insurance might be unaffordable for somebody young. However, the need is there. So what we often do is a blend and recommend maybe $1.5 million of inexpensive term insurance, and then maybe 500,000 or even less of whole life that will grow over time once the term insurance expires. Another way is what's called economic life value, and you can certainly Google that. I won't take time to go through that, but it's a way that determines current income, number of years to retirement, and also taking into account other assets, expenses, liabilities, mortgages, car payments, et cetera, and calculating a correct amount. It's fairly scientific rather than back of the envelope. So that website, lifehappens.org, is a terrific resource to be able to go and look at different calculators to see what's the right amount for you and your personal situation. Employer provided life insurance. You may think you're sufficiently covered because you get insurance through work. And many people think that because they don't really understand what is the need, what is it they'd like that insurance to do for their family. But as I mentioned, it's fairly limited from what employer provided coverage is. It's generally 1 to 2 times base income, base salary, I should say. It may not go with them if they leave and go to another company. It may only provide limited benefits. And often employer plans change. They get different brokers who bring in different carriers, and sometimes the rules change or could in fact be dropped entirely. We've had business clients that during tough times, they stop providing this kind of benefit. So it's always a good idea to know and be able to have your own policy that's yours no matter what happens or no matter what happens with your employer. So what happens if you purchase life insurance on your own? You can supplement what life insurance you do get through your employer. And as I mentioned, many employers offer supplemental life insurance that doesn't require medical underwriting. We haven't really talked about that except at the beginning when I mentioned that it does require good health. But group life insurance from employers does not require any type of medical underwriting. So it is required to take all people regardless of their medical condition. when you purchase your own policies, you do have to go through medical underwriting. So it does require some level of health. And the healthier you are, as I mentioned, the least expensive it is. Um, and also, when you own your own policy, it's yours. It's portable, we like to say, and wherever you end up, you can take it with you as long as you continue paying the premiums on it. And you certainly have more choices on what type of life insurance you can purchase, whether term, whether whole life, whether universal life, and you get lots of help, lots of resources on helping you choose that. And by the way, that is a big component of our practice. We do offer life insurance and disability and long-term care insurance for our clients. And while we're affiliated with Mass Mutual, we are actually independent and can shop the entire market, which we often do. So regularly, I can't tell you how many times people will say, well, I do have a life insurance policy, not really knowing that their credit union gave them accidental death and dismemberment for free for $500, which is really not life insurance. But if you do have a policy, it's a good idea to have it reviewed periodically because life happens, life changes, things change. You want to make sure that your beneficiaries are up to date. Um, it's funny that we have clients that maybe have had different spouses in the past, and when we review their policies, we find out that many years later that their former husband or wife is still the beneficiary of their big life insurance policy, which usually irritates their current spouse. So we make sure that they're changed and updated. Any of these life events have recently occurred: health improvement or quit smoking, again, beneficiaries. The financial professional that sold the policy to you, is he or she still active? And is your carrier maintaining its financial strength? Insurance companies are like bonds. They're rated by companies that actually also rate bonds. So Standard and Poor's, Fitch, AM Best are a couple of the more popular rating agencies. And you can tell the strength of an insurance company through their ratings by those. I prefer a rating called Comdex, COMDEX, and it will look at any insurer and give a score from 0 to 100, 100 being the best. And the companies we deal with are at least have a grade of 90 or better. So you want to make sure that the insurance company you're working with is going to be around when you need it, right? Providing financial protection for your loved ones, that's really kind of the most critical consideration for life insurance. We mentioned there's two types of life insurance. There's term insurance and permanent life insurance, which includes whole life and universal life. And just a word on that: whole life has some unconditional guarantees that universal life does not. So the guarantees on whole life is that the premium remains constant. It can never go up. The death benefit will never go down. In fact, it generally grows. And then thirdly, the cash value is guaranteed. There's a guaranteed amount of cash that will go into every policy. And most of the companies we deal with, they pay dividends. So in fact, the cash value grows, the death benefit grows over time, the premium stays the same. And it's a kind of a virtuous cycle that happens with those. Universal policies have their place. They're probably more popular for people that have varied income. They don't have regular income. So sometimes salespeople or business owners that have seasonality in their business like the concept of universal life because they can pause their payments. They can pay more, they can pay less. But it does not have the guarantees that whole life does. As it says here, some policies offer potential to accumulate cash value, which can be used for any need. I think we covered that quite extensively. And then lastly, ensure that your life insurance policy meets your needs, your current needs. With that, I'm going to ask Susan to come back and see if you have any questions. And I thank you for your time.
Great, thank you, JP. And I'd like to invite Jane on as well if she wants to help answer any of the questions. And before we go into our Q&A, I wanted to let folks know that JP and Jane have a poll that they would like to ask everyone to complete if you can stay on for a few seconds afterwards. So after the Q&A, we will be releasing a poll if you can answer the few questions that they have. And that said, I see that we've got 2 questions in the Q&A. And the first one is, when is a good time for me to buy life insurance?
Yesterday. So as I mentioned, it's you're never going to be younger than you are today. As we get older, sometimes our health isn't as good as it is when we're in our 20s and 30s. So it just simply becomes more expensive. But if you think there will be a need in the future, I would definitely encourage you to look into, and it's very easy to do that these days. Look into getting some life insurance, if nothing else, to lock in that low premium. I hope that answered your question.
Great, thank you. And the last question is, can I take out a life insurance policy on my spouse?
So can I take a life insurance policy on my spouse? You can actually take a life insurance policy. Yes, the short answer is yes, but the spouse has to be, as the insured, she has to approve and go through the medical underwriting. And so the short answer is yes. Jane, anything you'd like to add to that?
Yeah, I mean, agree. We still would have to have the other person agree and give us authorization to be the insured, and you can own the policy on that person. So, and then the other thing, Susan, if anybody in the audience is interested in doing an insurance review, feel free to reach out to us, and we will give you a complimentary insurance review.
Yeah.
Okay, great, thanks. And I just wanted to let folks know before we go to the last question that in the chat box, there's a link to the handouts from tonight's program, and the contact information for JP and Jane is there as well. And finally, the last question is, can you buy life insurance with a nonprofit as a beneficiary, such as the Walnut Creek Library Foundation? Excellent question.
That is an excellent question. And the answer is a resounding yes, you can. It's actually a great way, if you think about it, it's a great way to leave a legacy for an organization, especially a nonprofit you care about. Because if you think about a death benefit, let's say it's a $100,000 policy, and it's a permanent policy, a permanent life policy. Even after 20 or 30 years, you still will not come anywhere close to have paid in $100,000. Yet when you do pass, the nonprofit, the Walnut Creek Library, will receive the full value of that. So there's some nice leverage that goes on to be able to get more of a bang for your buck by leaving gifts to nonprofits or other. It doesn't have to be a nonprofit. It could be in other individuals outside your family, where they'll receive much more than you actually put into that policy. Great question.
Yeah, it's a very tax efficient way of leaving money, so it's good.
Well, I just want to say thank you. Thank you, JP, for tonight's presentation, and to you, Jane. To our attendees, the poll has just been released, and please go ahead and complete it. And I will wrap up tonight. If you enjoyed tonight's program, we invite you to consider making a gift to the Library Foundation. You can donate on our website, wclibrary.org, and know that your gift will make a difference. We hope you will join us for the next Finance 101 program, Medi-Cal eligibility rules and special needs planning basics on April 8 at 7 p.m. Kirsten Howe from Absolute Trust Council will discuss that with proper planning, you can stop the rapid outflow of cash before it's all gone. And also for parents concerned with providing financial security and stability for a special needs child, Kirsten will cover the resources available to help cover your child's personal care needs, financial and legal needs now and for the future. And you can register for that program on our website as well. We hope to see you in 2 weeks, and thank you again for attending. Good night.